Money becomes easy to understand only when it stays visible. A salary arrives in an account. A card pays for coffee. A transfer moves through a banking app. A receipt appears. A balance changes. For most people, that is what money feels like. Visible, traceable, ordinary, approved. But the moment value moves without introducing itself, without waiting for institutional permission, without leaving the kind of footprint people expect, finance begins entering a different world entirely. And that world has existed far longer than most people realize. Because long before digital banking became normal, long before mobile payment applications became common, long before people learned to trust screens more than paper, human beings had already built systems for moving value quietly across distance, across borders, across conflict, and across situations where visibility itself became a problem. Not because secrecy was always criminal, but because speed, trust, survival, and circumstance often demanded alternatives before formal systems could respond. That is why hidden money never begins as mystery. It begins as adaptation. Whenever formal systems become slow, expensive, restrictive, unstable, or inaccessible, another layer appears. That layer may begin as practical necessity, but over time it often develops its own language, its own trust rules, its own invisible corridors, and eventually its own shadow reputation. Most people imagine hidden money as dramatic. Dark rooms, coded conversations, secret devices, impossible passwords. But in reality, hidden movement often survives because it looks ordinary. It passes through familiar streets, familiar businesses, familiar conversations, ordinary human relationships, and daily economic behavior that appears harmless unless someone understands what is happening underneath. And that is why many hidden systems survive quietly, because invisibility rarely depends on darkness. It often depends on normality. A bank depends on identity. It depends on documentation, compliance, timestamps, institutional architecture, reporting layers, legal accountability, and visible authorization. But trust-based financial movement can operate differently. It may depend less on identity and more on relationships. Reputation, memory, reciprocal obligation, geographic familiarity, and long-established confidence between people who may never need digital proof to complete what formal systems would call a transaction. That difference matters because once money stops depending entirely on official infrastructure, it becomes harder to define where movement begins and where movement ends. Sometimes nothing physically crosses a border, yet value appears elsewhere. Sometimes no obvious transaction exists, yet equivalent value settles quietly in another location, through balancing relationships built long before authorities even notice activity. And that is where ordinary understanding often stops too early. Because most people still think movement means physical transfer. But advanced financial movement often means adjustment rather than movement. It means one side records obligation, while another side settles later through unrelated channels. It means value can appear disconnected from the event that created it. This is one reason hidden financial systems survive across generations. They do not always rely on immediate completion. They rely on continuity. A trusted network does not need every exchange to finish instantly, if everyone involved believes future balancing will happen reliably. In formal finance, trust is replaced by systems. In hidden finance, systems are often built from trust itself. That principle is older than modern banking. Across many parts of the world, merchants once needed methods to settle value without carrying dangerous amounts of physical wealth through unstable territory. Roads were unsafe. Borders were uncertain. Political control changed quickly. So people built invisible financial confidence through intermediaries whose names mattered more than paper. A promise in one city could unlock value in another because reputation itself became currency. And once reputation becomes currency, financial movement no longer depends entirely on visible money. It depends on confidence that obligations will eventually settle. This is why some hidden systems look almost too simple from outside. A phone call, a note, a code, a name, a remembered amount. Sometimes the visible action appears insignificant while the real financial meaning happens beneath it. Modern viewers often assume technology created invisible money. In truth, technology only accelerated something older: abstraction. The more value separates from physical objects, the easier it becomes to move conceptually before it moves visibly. Digital systems did not invent hidden layers, they simply gave hidden layers new speed. That speed changed everything. Because once digital wallets, layered accounts, international payment interfaces, tokenized value, and distributed digital instruments entered normal life, hidden movement gained new environments where ordinary volume could hide unusual intent. When millions of legal transactions happen every minute, visibility becomes harder, not because systems fail, but because noise becomes enormous. And noise is powerful. In finance, noise protects patterns by burying them inside ordinary activity. A single unusual movement inside an empty room is obvious. The same movement inside a crowded marketplace disappears unless someone knows exactly what signal to isolate. That is why authorities often struggle less with seeing transactions and more with interpreting meaning. Because not every unusual pattern is illegal, and not every legal pattern is harmless. A structure may look normal, while its deeper purpose remains hidden behind timing, fragmentation, intermediaries, and layered ownership. Ownership itself creates another layer. The person benefiting from value is not always the person appearing near the transaction. In visible finance, ownership usually has a direct path. In hidden finance, ownership may be buffered through layers designed to separate action from benefit. Not always illegally, but often strategically. And strategic separation is powerful because law usually follows visible connection first. If connection becomes delayed, fragmented, or distributed across jurisdictions, understanding becomes slower. Meanwhile, value continues moving. This is where geography matters more than most people realize. Money behaves differently when legal systems differ. A transfer acceptable in one environment may appear suspicious in another. A structure ordinary in one country may create blind spots elsewhere, simply because legal definitions do not align perfectly across borders. And whenever systems do not align perfectly, friction appears. Hidden money often studies friction carefully, because wherever friction exists, there is usually opportunity for concealment, delay, reclassification, or reinterpretation. But hidden movement is not only about crossing borders. Sometimes it survives entirely inside ordinary domestic life. Cash-heavy sectors, layered purchases, rapidly rotating small transactions, fragmented settlements. These can create environments where meaning becomes difficult to read because individual parts appear harmless alone. This is why size often misleads people. Large transactions attract attention. Smaller, repeated patterns often attract less attention, even when total value becomes significant over time. Human systems naturally notice what looks dramatic first. Quiet repetition survives longer, because it rarely feels urgent until accumulated meaning becomes visible. And accumulated meaning is difficult because financial systems usually examine events faster than stories. A transaction appears immediately. Understanding why it happened takes longer. Hidden finance often survives inside that delay. Technology then adds another complication. Identity itself becomes softer in digital environments. A name on a screen may satisfy one system, while another system sees only a partial layer behind that name. Verification improves constantly, but so do methods of creating distance between visible identity and actual control. This does not mean hidden money always defeats systems. It means systems constantly evolve because hidden movement also evolves. Every improvement in monitoring creates pressure for more adaptive concealment. Every improvement in concealment creates pressure for smarter analysis. Finance becomes an ongoing intelligence contest. And intelligence in finance rarely belongs only to machines. Human judgment still matters, because hidden movement often hides inside behavior before it hides inside numbers. Timing, relationships, context, unusual consistency, unnecessary complexity. These often reveal more than raw amounts alone. For example, complexity itself can become suspicious when simplicity would normally be enough. If value reaches a destination through 5 layers when one would have worked, the structure itself begins asking questions even before anyone understands intent. Because ordinary finance usually prefers efficiency, hidden finance often tolerates inefficiency if distance creates protection. And that difference matters deeply. Protection is one of the strongest motives behind invisible financial architecture. Not every hidden layer begins from aggression. Some begin from fear. Fear of instability, confiscation, conflict, sanctions, volatility, institutional distrust, political uncertainty, or sudden loss of access. That is why hidden systems cannot be understood only through crime. Some invisible financial habits were born from communities that learned survival during unstable periods when official systems failed repeatedly. Once trust shifts away from institutions, invisible alternatives become culturally durable. And when culture supports invisible systems, they survive longer than laws expect. Because people do not abandon trusted methods simply because formal alternatives become available, especially if older systems proved reliable during difficult years. This creates an important lesson. Hidden money often survives not because it is invisible technically, but because it remains socially believable inside specific networks. A stranger may see confusion. Participants see normality. And normality is powerful camouflage. Modern digital assets added another layer to this conversation, because now value can exist in forms ordinary people still struggle to explain clearly. Some digital value moves openly, yet feels conceptually difficult for many regulators, institutions, and citizens to interpret consistently. And whenever understanding lags behind adoption, temporary shadows appear. But shadows do not automatically mean illegality. They mean interpretation becomes slower than innovation, and hidden actors often study those delays carefully. Because delay is opportunity. Every financial era creates temporary blind spots when new tools arrive faster than shared understanding. Paper money once created trust problems. International transfers once created trust problems. Cards created trust problems. Online payments created trust problems. Digital assets created trust problems too. The pattern repeats because finance changes faster than public intuition. And public intuition often stays simple. Money should be visible. But advanced financial reality says value can separate from visibility, while still remaining economically powerful. That truth is uncomfortable because it means ordinary financial education is incomplete. If it teaches only official pathways, it is not enough to know how banks work. One must also understand why alternatives keep appearing whenever systems become too rigid, too slow, too expensive, or too politically uneven. Because hidden movement usually enters where formal systems leave emotional or structural gaps. And those gaps are often human before they are technical. People want speed, people want certainty, people want access, people want discretion, people want continuity. Whenever official systems fail one of those strongly enough, alternatives begin forming quietly. And once formed, they rarely disappear completely. They adapt, they blend. They imitate legal structures where useful. They borrow language from formal systems. They sometimes even hide best by appearing modern, compliant, ordinary, and professionally designed. Which is why surface appearance means less than most people think. A polished interface does not guarantee transparent intent. A rough environment does not automatically imply hidden danger, meaning lives deeper than appearance. That principle matters beyond crime. It matters for understanding modern finance itself. Because legal and illegal money often move through similar physical channels at certain stages. What differs is intent, structure, reporting, timing, ownership logic, and ultimate purpose, not always the visible first movement. And that makes financial intelligence difficult. Systems must distinguish meaning without treating all complexity as guilt. That is why serious financial monitoring depends increasingly on patterns rather than isolated events. Patterns tell stories numbers alone cannot. Repeated fragmentation tells a story. Unusual timing tells a story. Circular movement tells a story. Layered ownership tells a story. Silence around obvious documentation tells a story. And still, stories take time to confirm. Meanwhile, value continues moving. That is why some of the most important financial battles today happen not in vaults, but inside interpretation. Inside the ability to understand what movement means before consequences become irreversible. And this returns to the deepest lesson. Money becomes hardest to understand when it stops behaving like what ordinary people call money. Because once value can move through trust, obligation, digital abstraction, layered ownership, fragmented timing, and social confidence, finance becomes larger than currency itself. It becomes architecture. Invisible architecture, some of it legal, some of it strategic, some of it dangerous, some of it simply inherited from older worlds that never disappeared. And the reason ordinary people rarely notice this is simple. Most daily life never requires seeing these deeper layers, but they exist beneath visible finance every day, quietly, continuously, often closer than expected, because hidden financial systems do not always live far away. Sometimes they live beside ordinary systems so closely that only intent separates them. And once you understand that, financial reality begins looking very different, not darker, not dramatic, just deeper. And perhaps that is the most important lesson of all. Invisible money does not always move because it wants darkness. Sometimes it moves because human systems still cannot fully solve the old tension between trust, speed, visibility, and control. And until that tension disappears, hidden financial architecture will continue evolving. Quietly, intelligently, and often faster than ordinary people imagine. If you enjoy learning how invisible systems shape visible life, subscribe to Sethtra Academy, because some of the most important systems in the world are the ones people rarely stop long enough to examine.